Hey guys, welcome back to the channel. Today's video, we're going to be going over a REIT portfolio update real quick, and then we'll be talking about what's happening in the REIT verse or the real estate investment trust universe. And then at the very end, I'm going to be talking about one particular stock that I'm keeping an eye on. So stay till the very end to get that information. All right, let's get into it. So this is going to be a quick portfolio update, guys. Like always, this is a live money portfolio. I just want you guys to see it. But something interesting, and it was kind of nice to wake up to. But, it looked like the portfolio recovered quite a bit. We went from 176 up to 185. All right. The last time I did a video, I think I was sitting at about 180 or 179. So the last time you guys saw this video or this portfolio, I was in the red quite a bit. So real quick, let's just get over some stats. So right now the portfolio sits at $185,952. I have a money weighted return of 0.086%. So we're on the recovery, it feels like, but we won't know for sure. As of this year, just year to date, I've only made $283 in dividends, and I have a market gain of $1,296. All right. So nothing too extravagant here. And basically, we're going to move on to the real estate news. And this is coming directly from Seeking Alpha. And I hope you guys can see this. But yeah, some down here it says real estate stocks bounce back to green, outperform broader markets. Okay, broader markets being the S&P 500, for example. All right, so real estate stocks bounce back to green after a not so positive start to 2025, and that is absolutely true. As the core consumer price index unexpectedly surprised to the downside, meaning that inflation or the CPI is basically continuing to trend higher. Right, inflation is still present in our economy, and inflation is still hammering away at everyday life. Right, so equities and especially bonds caught a major break on the report as the favorable inflation data reignited bets that the Federal Reserve will continue to ease monetary policy. So this is a good sign because right now, in the markets, everyone is kind of discounting or was discounting that the Fed was going to cut more than 2 times next year, or this year rather. So now a lot of investors are under the impression that because inflation is still pretty elevated, that they are going to cut more this year. It could be even as high as 3 to 5 cuts this year, but we won't know that until much later. With inflation back to trend, from the Federal Reserve Governor Christopher Waller sees the possibility of 3 to 4 interest rate reductions in the first half of 2025. He said on Thursday, provided the data cooperates. Now, again, you got to take some of this with a grain of salt. Yeah, you just got to take it with a grain of salt. I don't predict that there's going to be 3 to 4 cuts in the first half. That's really, really, really aggressive. That means in 6 months there's going to be 3 to 4 cuts. Heck no. I probably predict maybe 4 cuts for the year. So maybe 2 cuts in the first half and maybe 2 cuts in the later half. But again, those are just guesses. Who really knows the real answers to this? But good news is the benchmark U.S. 10-year Treasury yield shed 6 basis points from last week to close to 4.63%. So that actually was positive because mortgage rates are influenced by the U.S. 10-year Treasury yield. So as these went down, so did mortgage rates, right? And when mortgage rates go down, that is very favorable for real estate investment trusts and real estate in general, right? So let's take a look at that. So this is VNQ, okay? VNQ is the Vanguard Real Estate Index ETF. It's similar to like the S&P 500 that you can buy. Basically, this is just a basket of all the equity REITs out there as well as the mortgage REITs. Okay, so if we look last month or even year to date, we can see that we had quite a spike. We had a 4.86% gain since January 10th. So again, very favorable, very good news. I don't know what the market's going to do today, but for right now, it's looking good. And this is just the Fed Waller saying rate cuts are possible in the first half of 2025. Again, we just covered that. But this is the 10-year Treasury. And we can take a look and go down to the 1 month, and we see that there was indeed a lot or a decent drop, right? It went from 4.78 down to 4.61. So a decent drop in rates, hopefully mortgage rates, we'd have to take a look at that. If we go here to current U.S. mortgage rates, we can kind of see what they're at right now. So let's take a look at, so as of January 19th, 2025, the average 30-year fixed mortgage rate in the United States was 6.7%. This is a decrease from the previous week's average rate of 6.78%. So pretty decent. Again, not bad. It's trending downward in the right direction, which is what we want. Okay, and that obviously reflected positively for real estate. So the one stock I have, that I want to talk about, and I'm keeping, well, before I get into that, let me just tell you guys this. For this portfolio, again, it's gone through some bad times, right? Obviously, it's gone through bad times, but I am holding a lot of cash, and I'm just waiting for the right opportunity to deploy it. Okay. You don't want to hop in at any time. You could dollar cost average, but when you want to really up those contributions, that is, having a lot of dry gunpowder is going to give you that ability. As you guys can see from here, you guys see it firsthand that I went from 54,000 up to 85,000, right? That was a huge contribution. And again, I went from 97,000 up to 128. And then I did it again to 154. Okay. So these were actually from the sales of, personal rental properties that I owned. And again, I moved a lot of my money into REITs because I saw that the future prospects were far more favorable than rental properties. And plus I was done with the headaches and all the problems that rental properties come with. But anyways, moving on, having a lot of dry gunpowder is going to be really, really good for you guys if you're holding for the long term, right? Waiting to take on these opportunities. And one such opportunity that I'm keeping an eye on is Realty Income. Okay. Realty Income has been talked a lot lately. It's been making its waves in the, real estate investment trust universe, or even the dividend income universe. A lot of people are starting to talk about Realty Income being, kind of a buy right now. I'm not saying whether you should buy it or not. I'm just going to voice kind of what I'm looking at. I personally do own Realty Income. Okay. Realty Income is a part of my portfolio. If we take a look at our triple net leases here, we can see Realty Income. I'm actually still in the green, and I have a pretty decent, investment into Realty Income. I have well over $11,000. Okay. Well, it's actually $8,000 with with about maybe a $2,000 or $3,000 gain plus dividend reinvestment. So I do have a sizable, position in Realty Income. So this is one I would definitely keep an eye on, and I am keeping an eye on. I'm waiting for probably a better opportunity for the price to go down to take advantage of that price dip. I think Realty Income is a great company, but it does not mean it's completely risk-free, and I'm going to explain why. So if you guys don't know what Realty Income is, it's basically a triple net lease REIT, and it basically leases out spaces to other well-known companies that like, and trust. And I will show you those companies here in a minute. Basically, Realty Income, ticker O, is an S&P 500 company, is a real estate partner to the world's leading companies. Founded in 1969, we invest in diversified commercial real estate and have a portfolio of over 15,000 properties in all 50 U.S. states, the UK, and 6 other countries in Europe. We are known as a monthly dividend company, and they have a mission to deliver stockholders dependable monthly dividends that grow over time. Since our founding, we have declared 655 consecutive monthly dividends, and they're a member of the S&P 500 Dividend Aristocrat Index. So they have, quite a bit of history. And right now, I believe this stock is yielding about 5.5 to 6%. So it's, on a hypothetical $100,000 investment, you could be getting $6,000 a year. And if you divide that by 12 months, that's like $500 a month or so, right? So pretty decent money. I think it's, for me, it's an attractive position, right? It's an attractive yield. this company is very attractive. They have strong returns. Compounded annual total return since 94 is 14%. Really, really good. Remember, we want to benchmark this against something like the S&P 500, which has historically returned between 8 and 10%. So, something like this, and I'm not doing the comparison against the S&P 500 right now because, again, we're going from 1994 to today. And that's not the point of this video. I'm just showing you guys what this is and kind of my thought process. And, it has a 4.2% compounded annual dividend growth rate, which is, it's decent. It's not bad. It's beating inflation. 655 consecutive monthly dividends and 109 consecutive quarterly raises. So really, really good in my opinion. And what we also want to look at, and it's not here, it's actually under our portfolio. And we go to portfolio diversification. Now, this is where things get a little interesting. All right, guys. And this is where you have to kind of think about the risk investing into a company like this. Okay. Realty Income is a great company. Don't get me wrong. I don't predict that I'm going to sell out of Realty Income anytime soon. I'm waiting for a better buying opportunity to really put my money into Realty Income. But if you look here, this is their top 10 industries that they are involved with. Okay. Grocery stores, convenience stores, dollar stores, home improvement, et cetera, right? These are their top clients, their top 20 clients that you know of. I'm sure you know of. There's Dollar General, there's Walgreens, there's Dollar Tree, 7-Elevens, Wynn Resorts, FedEx, BJ's, Tesco, CVS, LA Fitness, MGM Bellagio, AMC Theaters, Walmart, Sam's Clubs, Home Depot. So they have, a very broad, diversified tenant base. And these are the top 20 clients. Now, this is, I'm going to get into this part in just a second, but let's take a look at the other, part of their portfolio diversification. They're in the United Kingdom, they're in Texas, Florida, California, Illinois, Ohio, Mass. And those are their top 7 regions. Their portfolio occupancy is fantastic. Okay. Since 92, they've always had about a 98% occupancy. Okay. When you're investing in real estate, occupancy is everything. If you have empty stores and empty rental units, empty rental properties, you're not getting paid, right? They've been able to manage at least a 98%, average, I guess, over the entire span, right, of their existence. These drops are 96%. It's never dropped below that. At least I don't see it. It's never dropped below that. So they've maintained quite a squeaky clean track record when it comes to portfolio occupancy. Okay, and then we look at their geographic diversification, Alaska, and then you got all the states. You have Spain. They have 91 stores, 28 in France, or properties, I should say, 310 in the UK, 4 in Germany, and then 34 in Italy. And I heard, and again, don't quote me on this, but I heard in an interview that Realty Income has been exploring expanding into more European countries and European markets. So we'll see what this could mean for Realty Income. And this is why I'm really, to be honest, bullish on the stock or bullish on the company because, they're a fantastic company. You can't stop them from growing. A lot of people are saying that they're too big and that they're not going to be able to grow. And it's going to be hard for them to grow. And, their stock is not, basically their stock is not attractive and all that other stuff. And I mean, I'm of the camp that they have an excellent team. They're always forward thinking. They've been, aside from their dividend that's been paid monthly consecutively, they've always been responsible in how they manage, 1, their balance sheet, and 2, investor money. Okay, so just my thoughts on all of this. They're not taking really crazy bets. They're not investing in markets that they don't know. Their most riskiest one was probably who was it? They partnered with, I think, Vici Properties, or maybe they bought the properties from Vici Properties, which is their gambling casino tenants, MGM Bellagio. So they ended up taking a position in that deal. And it's outside of their sphere of competence, to be honest, because they have no gaming and leisure properties other than other than MGM Bellagio and I think one other property. But it seems to be working out well for them. So again, just my two thoughts. So moving on. So we have Dollar General, Walgreens, and Dollar Tree. These are 10% of the entire portfolio. That's pretty large, okay? And if we look at Walgreens stock, it hasn't been doing very well. That is an understatement. They have not been doing well at all. And only, now they look like they're coming back up. I mean, who would have thunk it, right? A 40% return year to date. But if we zoom out a bit, I mean, it looks like they've been going through a lot of pain. Okay. Basically, this is being attributed to, the stock falling has been attributed to basically failing prices, or not failing prices. Basically, there's a lawsuit going on. Actually, it's right here. What am I doing? There's a lawsuit going on that dropped its price substantially. Walgreens Boots Alliance Inc. has seen its stock decline due to a lawsuit filed by the U.S. Department of Justice, accusing the company of contributing to the opioid crisis by improperly filling prescriptions. All right, this legal challenge has unnerved investors, resulting in a hold rating consensus and a share price target set below its current level, reflecting worries about its potential financial and reputational impacts. All right, so that is a part of it, and this was, this article came out today, actually. So, yeah. Walgreens has just been going down. Now, let's look at Dollar General, which is another big piece of the pie. If we look at that and we look at the 5-year chart, again, it's just been going down. Now, Dollar General and Dollar Tree, they get a lot of their products from China, and I believe that the reason why these two companies are feeling the pinch is because of, the potential for tariffs and increased costs, and basically the items in the dollar stores are not going to be $1 anymore. They're going to be substantially higher, right? They're going to cost more to import, cost more to bring in, which is obviously going to harm these companies that, basically sell cheaper goods. So if we look at Dollar Tree, same thing, same exact thing, right? They've just been going down, trending downward. Will they recover? I have no idea. Right here, August 29th, this article came out last year from Reuters. Dollar General shares plunge as rising competition fuels forecast cuts. Dollar General's shares slumped 29% to a more than 6-year low on Thursday after the discount retailer slashed its annual sales and profit forecast as competition for budget-conscious shoppers intensifies in the U.S. All right. Again, same thing here, right? And if we look at O stock, all right, this is for Realty Income. If we look at the 5-year, over the 5 years, here's the pandemic. It looks like it hasn't been really doing all that bad, but not all that good either. This is obviously from the highs of 2020. Let's see, 2021. Where is it? Yeah, so 2021 going into 2022. It's had a 23%, price decline. And I think these two companies in its portfolio, these three companies, are elevating the risk for Realty Income. I think so. This could potentially lead to store closures. I know Walgreens has already closed some stores. Dollar General has closed some stores. Dollar Tree has closed stores. If these three companies basically go out of business or go bankrupt, and they have to close more stores, this is going to affect Realty Income, because these three companies make up 10% of its client base, of its portfolio. So again, in my mind, this elevates the risk for Realty Income, and it's probably something I would just keep an eye on. Again, this isn't an in-depth analysis of Realty Income. This is just some kind of like high-level thoughts that I have about Realty Income. Okay, it's just some things I'm thinking about it. I still think it'll be able to navigate through these, kind of volatile times. And even if some of these clients do end up going out of business or basically going extinct, going the way of the dodo, I believe Realty Income has a smart enough management team, smart enough people to figure out how to navigate these waters, how to find new tenants, how to find new clients, and bring them into kind of their world, right? Bring them into, get them signed up for new leases, get them into buildings, get them renting, get them paying rent, right? Which obviously is going to be good for the company. So that is pretty much my thoughts on Realty Income. So, oh, there we go. So yeah, that's pretty much my thoughts on Realty Income. So that is kind of everything up in a nice, neat little bow about the portfolio update, what's going on, and kind of like what I'm doing to position myself to take advantage of, what's potentially to come. So yeah, that's pretty much it, guys. I hope you guys like this video. Please let me know down in the comments. Are you investing in O? Does this look like an opportunity that you'd be, open to? Is this something you're thinking about investing, or you're already investing in it? Let me know down below in the comments. And that's about it, guys. I will see you guys in the next video.